So talking about Saudi Arabia, maybe Jalal, we have obviously we want to talk about the whole region, but Saudi Arabia has been a very spectacular example of how when there's a will, there's a way, there's lights popping up all over the place, things happening, numbers growing. Pretty sure if we do this in a year's time, those numbers will be significantly higher. There's 3 SBL models and with different outcomes. Maybe you can.
I think globally, these are models that you see active at different kinds of firms and different kinds of service providers. And the first one or easiest one we usually see is agency lending. It has the least amount of risk. It has the least amount of balance sheet impact on the participants. And it's a model that we see most active in developed markets. It's the model that we see our clients using when they lend their international assets. The other 2 models that we've seen that have a place in Saudi and will continue to, one is what we're using, which is a pooled principal model. So we're facing multiple qualified clients as principal. We're borrowing those shares and then onward lending to another counterparty or another client. So that model allows us to face multiple counterparties through SNB Capital. They're generally comfortable with our balance sheet and our risk. And it allows people who maybe wouldn't have access to those counterparties directly to enter into those transactions through us. And then the last one is maybe what we started seeing initially when the stock loan regulations came out, which is purely bilateral trades. The challenge obviously with bilateral trades is if one side wants to return or call back, it's hard to get those securities reused or to substitute that loan out. Whereas in agency lending, in pooled principal, even if the lender wants those shares back, we can substitute that out with another lender potentially in the queue or in the pool. So it gives borrowers more stable inventory, more stable supply. From a practical perspective, we think all of them need to exist in Saudi. We don't think it's going to be just agency lending. We think there's a place for each one of those. Saudi is a market, when you look at demographics, that's similar to some of the large Asian markets where you have 60, 70, 80% ownership and activity from retail and high net worth investors. It used to be 90%. So that kind of investor isn't going to be able to go into the institutional agency lending programs. They need a pooled principal program to be able to work. And we think all of those models are going to be active in different sets of lenders and different sets of borrowers in the Saudi market.
What do the representative, the international community think about this?
So obviously for us, the agency model is the one we'd always push, given that that's the business we're in. Interesting. Actually, I'm going to go back a little bit because on the agency model, I think we talked earlier about sort of client education, investor education, right? And when you're going in to talk to a community who maybe this is a new practice for, I think the agency model, as you mentioned, covers the most, carries the least risk, easier to get, kind of dip your toe into the water, understand the market. You're essentially outsourcing the function. So you have sort of guardrails that your program is going to be run by, makes it easier for you to enter the market. So I think that's one which we'll really see the agency model pick up and maybe hopefully drive ahead versus the other two. The point you made around, and it's a really interesting point, because since moving to the region, I often get sort of messages from my bank, etc., telling me to invest in this and invest in that from a kind of IPO perspective, which you don't get from NatWest in London, right? So the retail market's big, but I'm not sure, Andrew, if you've seen this, but we've seen a big push for what we call the aggregator model. So kind of what you call the pooled principal, but where you have the broker or the client's broker, and they almost act as the principal, but through an agency structure. So they essentially sit at the top, they aggregate all that retail flow, and then they face off as the kind of lender or the beneficial owner, and then make their assets available. And we've had a lot of success with that model kind of within Europe and in Asia. And one of the things that's always ticking off in the back of my mind is the GCC countries are primed for that sort of model. You've got multiple of these retail brokers that are out there making sort of giving access to the stock markets to their underlying retail clients. If we can tap in and almost see that as the beneficial owner, we can access a large part of the supply in the market, but only have one client. So I don't know if you've seen that in Saudi.
So basically, that's the model that we're doing. I think the challenge in Saudi is that for me to enter into a securities lending trade with a counterparty, if I'm not a qualified investor, I have to have a lending agent. So we couldn't act as lending agent and principal at the same time. So we have to only face lenders who are qualified, which is a relatively low asset test. So you're talking about around 5 million riyals or $1.3 million. So a lot of clients meet that requirement, obviously. And we think, again, that's what's allowing us to tap into a different liquidity pool than an agency model might ever be able to attract. Yeah.
Dimitri.
Just to add to that, because I think it's a really interesting point on supply, and given the ownership structure here as well, and taking on board everything you said as well. What we're seeing from a global perspective is that fully paid lending, or we call it client asset lending, as Equilend, that's a huge growth market for us. So it started with the likes of Robinhood in the States, and it's growing significantly in the States. We're now seeing that in Europe as well. And the number of conversations I've had with people in the region about client asset lending or fully paid lending is growing each week. I think technology has a huge part to play in that, because the challenge with mobilizing that supply, where retail brokers could have thousands, millions of underlying accounts, trying to aggregate all of those up into something that a broker dealer is going to be happy to borrow from, is the challenge. But again, the technology exists for that to happen today. And then also not just the aggregation piece to lend out, but then the income piece to distribute again. So technology plays a huge part in what you've suggested there. And I think it's only a matter of time before we see that move from the States to Europe, to Asia, and to the region as well.
Yeah, like we're seeing the exact same thing. The fully paid lending programs. Like Andrew and I have a joint client using technology to do it. It's an extra layer of allocation. It's an extra layer of fee distribution. It's an extra layer of collateral allocation that you need to take down to underlying retail investors with small amounts of shares in each one. So there's a lot of data churn, there's a lot of flow, based on where you are in the world as well. There's a requirement in some cases to report to the regulator about those trades that was never there 3-4 years ago. So there's a real technology shift to be able to do that. But the benefit that the firms get is you're definitely bringing in more revenue. That upfront investment in the technology allows the additional revenue to come in, and even your business partners in Asia, we speak to on a regular basis about exactly the same thing. How do we help with those technology shifts?
I think just to kind of round that out, Dimitri, you mentioned at the beginning, right, the stats around the available inventory versus the on loan. It's a well-known fact the securities lending market for a very long time has been significantly oversupplied, right, in terms of lendable versus on loan. And it's these sorts of things that give you a new source of supply that allows you to drive that on loan balance up without kind of having to really drive up the lendable.
And just to add to that, because just to take Jalal's point as well, that those pools of assets are often more in demand from the broker-dealer community because they are quite unique. We see it in Scandinavia as well. When you get some of these lenders in Scandinavia who have access to domestic owned supply, they're immediately in demand from the broker-dealer community because what they're bringing to the table is very different from what they're seeing in the supply terms.
So we have a win-win-win-win-win solution. Is that correct? I think everybody's a winner on this one. Is this sufficient? In terms of going back to the initial point regarding the initiatives.
Yeah, so I think the next thing you sort of have to look at is the demand, right? So it's great, we can capture all of the supply, but if there isn't enough demand and there isn't products that need those shares as a borrower, you're not going to have enough to have a fair and a balanced market. So I think that's where we're starting to see growth. The exchange traded derivatives and market making, while they might look great on the surface, market makers are the worst clients for stock loan because they literally...
You sure you want to go on record saying that?
They literally take the stock for 1 day or 2 days and they return it. So from a lender's perspective, where it's a new market and you're trying to get them active, they don't want to lend their shares out for a day or two, right? That's not going to generate anything meaningful for them. So then you have to start looking, saying, well, who are the kinds of counterparties that would be good borrowers, that would have good utilization, that would be paying good rates? And then you start looking at long short, you start looking at other strategies that have those kinds of horizon. And I think what's interesting is that in the region, especially we're in the UAE today, there's a huge amount of funds now that are set up with regional bases. And they're not just trading globally. They're coming to Saudi, they're coming to other regional markets and seeing how they can be part of the capital market activity. And that includes IPOs, it includes stock loan, it includes even strategies that we don't see elsewhere, like corporate action arbitrage, like merger arbitrage, that we've started seeing demand to borrow that didn't exist a year ago, it didn't exist 2 years ago.
Eli, this must be music to your ears.
No, definitely. In fact, unlike my colleagues here, in fact, I don't sit on the custody side, so I sit on the investment banking side, so mainly on the borrow side of the market to implement some derivative solution. I fully agree with what Jalal mentioned. The demand is picking up. This is helped by new asset managers, hedge funds coming to the region, definitely. But it is helped as well by the market context, by the actual economy. We are in an environment where there is volatility on the equity market. We're no longer in a one-directional equity market that is growing for a decade. Volatility is here. Asset managers are looking for hedging solutions. For hedging solutions, you need an SBL market, an efficient SBL market. You have inflation. Inflation is here, is killing part of the returns of the asset managers. They are looking for some yield pickup solution. Yield pickup by call overwriting, by lending, etc. Call overwriting, you cannot do it without an SBL or access to an inventory. You have high interest rate environment, right? 3-4 years ago, you used to have access in the market here to cash in a free and abundant way. It's no longer the case. Now funding is very costly, so investors are looking for cheaper, more optimized funding solution using derivative instrument. It's not possible to implement without an operational framework, SBL framework, and the borrow is needed. So yes, definitely the supply is here, but the borrow side will follow the supply. That's why we need a diversified and stable supply, in fact.
So we're going in the right direction. I'm sure you have a few things to say. Sarah, you're on the receiving end here. Are you feeling these knocks on the door saying more?
If we speaking in general about the growth here in Saudi, so there is a capital market. So the capital market maybe activities has grown exponentially in the recent 5 years, and the reason is that due to the changes that is happening in the market. So maybe Jalal, Andrew, and Dimitri has mentioned before that there are changes in the market, the introduction of the qualified foreign investors, the independent custody model, the listing, the IPOs, and the post-trade enhancements, the introduction of CCP, CSD. I think this also helped positioning the Saudi exchange of the Tadawul to be the 10th largest global exchange in the globally the market capitalization. So I think this has encouraged strong demand and the growth both from the market and the investor side.
That has a knock-on effect as well. So, all of those points have then led more investors to start on the buy side, to start taking positions in the market. And then that's where HSBC is one, but we hear from all of our borrowers now, they're having conversations with their clients about access to the region, access to Saudi Arabia particularly. So whilst we said earlier we took a bit of a leap of faith to try and go live in lending in Saudi Arabia, it was only because we're getting a huge knock on the door from all of our borrowers, and they're getting the same conversation from their clients.
And then knock-on effect goes to Darren and the few firms that have the capability of offering the know-how from elsewhere, which means that
you used the phrase earlier, win-win-win. It's at what cost though, and that's the thing that we've really had to work hard with our clients on, is understanding the cost of getting into the market to begin with, around, let's call it the build and implement stage versus the run and operate stage. Quite different. So you've got an upfront build integration cost to deal with to do trade number one, let's call it. You've then got an ongoing run cost, going back to, I think, it's Andrew's point around operationally as well, like how do you manage the book, how do you manage the risk, do you do it out your global team, do you have a local team here on the ground? There's an investment to be made or not, depending if you're a local firm or a global bank. All of that really drives back to the quality of the assets that are available for lending and the utilisation of those. We've worked with a couple of clients to look at their business cases, and if it was a GC book, pointless. The volumes are so small, but because they're specials or high value assets, it allows them to do that investment. So quite a lot of the work that we do, let's call it at the start of any engagement with a client, is understanding what their operating model is going to be, how they're going to service things, helping them cost out what that would look like technology wise, offer them additional what we call business processing support, so back office for hire, those types of services, or educating their own teams to do those things themselves locally. That can all, it adds up. There's a cost of implementing all of that, which probably 2 years ago there wasn't volumes there. I think Jalal said that 2 years ago. Now there's definitely volumes there to back it all up, and that's where we just don't help with technology, it's other stuff.
So Dimitri, in order to be able to make sure that we don't get too carried away here, what are the dangers here? What are the things that this community needs to be able to aware of, be careful, in order to make sure this continues as a success story? If that's a fair question.
I think the important thing, and we've all mentioned it today, I think it's that sort of consistency aspect. It's to make sure that whatever regulations we're putting in place and whatever product design we're putting in place is consistent and essentially leads to efficiency in the market. Because I think that efficiency in the market is key, because borrowers are more likely to pay up when it's more efficient to them, right? So globally, whichever market you're looking at, and Jalal said it earlier, if there's no borrow demand, there's no market. And borrowers, and we speak to them all the time because they're on our trading platform, the one thing that they're really interested in is analytics and data around their trades and their trading activity and their counterparties. And they are more likely to trade and engage with counterparties that are efficient to them because they're under cost constraints as well. So it's really, really important to ensure that, yes, we're growing this market, but when we're looking at how to grow it and take it to the next step and beyond, which we all agree that's going to happen here, that efficiency point and trying to do things with best practice in mind is important.
So if I take that point, maybe to close this chapter, say we are at a point now where we have some serious people around the table with a track record, which is not the case all over the world. Spectacular maybe, but there's a reality here. What's the outlook? Where do we expect well, we mentioned obviously the demand is going to be key because that will pull the grow in the chicken and egg story. But what's the outlook for the region? Let's say, are we looking at Saudi going ahead and the others following? Are we looking for bits and bobs to adjust? Are we looking for a pan GCC market? Is that the solution, which is not so far away on the cards? So I'll start with Jalal then.
So I think the market standardization is a key point, because if you look at agreements, you look at operating models, even you look at what's your cutoff for RQVs? Are you taking same day because Saudi is that much before UK? I can take same day, or am I going to take next day like I do the rest of the world? I think these are all critical things. I can say from our perspective, when we came and we joined ISLA a couple of years ago to learn more about securities finance and how it works globally, we took a lot of positive feedback from the global participants and tried to say, okay, well, there's clearly market standards and practices that they were willing to share with us and to help us learn and develop our own capabilities in our own market. And I think we have to take the same approach now for the market participants, whether it's the people in this room or wider. We have to be willing to share information, to share ideas on how we do things, and try to come to common standards and common practices. Because at the end of the day, if I have my own ecosystem and another custodian has theirs and the international banks have a third one, it's going to be very hard to do things between different custodians, between different counterparties, and it's not going to allow the market to be efficient. You're going to have different pricing depending on how you're documented, depending on how you're set up. So I think market standardization is the key thing, and we have to maybe put our own business interests aside and say, well, how do we do this in a way that benefits everybody and grows the market?
Yeah, in fact, before tackling the outlook or the future of the SBL market, or more widely, I would like to go back to where roughly it started. In fact, 2013-14, there was a will from several countries in the region to increase liquidity and to bring more foreign interest into the market. That's where the discussion about index inclusion started. This is what happened 2018-19, where many countries within the region were part of some emerging and global indices. This was on the secondary side. On the primary side, We all know that IPOs in the region is very active, among the most active regions in the work. So work has been done on the secondary and the primary side on the cash equity. So the success was, and the bet was successful, to bring more liquidity into the market and to bring more foreign investment into the market. So this is done. Having done this, you are obliged or you are requested more and more to build an efficient capital market. What is an efficient capital market? Once you brought the liquidity and the capacity, the second step is efficiency, as mentioned by Jalal, and it's a must. What is an efficient capital market? It has three pillars. Liquidity, it's here. Derivative market, but guess what? Derivative market cannot work without an SBL market. So to be in line with any growth or vision plan to grow the capital market, whether in Saudi mainly because it's the biggest economy again, etc., or in other region, to have an efficient capital market, you need the three of it: liquidity, efficient derivative market, and hence you need to have an efficient SBL market. And we, HSBC, as a multinational bank, well established in the region, again, we started from the early beginning, and we are very well positioned to participate in building this bridge between the East and the West. We are very well engaged in any corridor between the Middle East and other region. We have been very, very well engaged in the corridor between Asia and the Middle East. We've helped some big asset managers in Asia to launch ETF with exposure to the market. So yes, we are fully confident that the growth story will continue, but it needs to be done again in a smooth and responsible way.
Andrew, you moved over. You've arrived. You are the future.
Look, I think it'll be a brave man or woman to bet against sort of the success of sort of the GCC as a whole on many different facets, right? I think bringing it back to kind of securities finance lending, what I think it's on us as sort of market practitioners, global custodians, agent lenders and the like, is to look at how we can develop the depth, because I think there's always this, this risk that we kind of go, all right, Saudi's done, now let's go to the UAE, then let's go to Qatar, Kuwait, and really spread ourselves thin. But I think one of the smart thing to do would be to sort of double down on, say, Saudi, for example, really look at all the different opportunities there are to explore and all the different mechanisms, services that we can put in place to help our clients. I think the big one, I think, Jalal, you mentioned this earlier, right, is got the lending side, but I think you also need the collateral side. And one of the things that we're very focused on is, as we build out the lending side, to also then be able to build out the ability to take Saudi domestic equities, for example, as collateral. The reason being, right, you've got all these banks coming into the region, there's going to be a limit on the amount of business they're going to be able to write if they can't then reuse the assets that they're taking. For example, if you're writing TRS, buying the underlying, if you can't then redeploy that, it's just sitting on your balance sheet essentially, right? So I think for us, I know the onus is on us to build out those solutions to help round out the ecosystem before we then start to look at other markets. I think there'll always be an element of understanding what's going on in the other countries, but to double down on Saudi and then look at the markets in the GCC.
As a representative of the technology providers, a lot of positives, and I've rarely heard that amount of positives, a lot of caveats as well. Maybe this view of doubling down in one country, is that even a luxury we can allow ourselves today? Or is a
certainly on the banking side, it makes perfect sense, because you want to make sure you've got something solid, a foundation for that business going forward. Because of the nature of all the other countries trying to keep pace or catch up, from a technology perspective, we will have to service all of the regions, no matter where they are in their story, their securities finance journey. So for us, it's interoperability. Andrew's mentioned it a couple of times, and it's spot on, whether that's at the pre-trade level or into the data vendor level, whether it's at the CSD level. Providing all of those capabilities is key to the evolution. So by evolution, more volumes. If the guys successfully bring on more clients, if they can't do them at volume because of constraints around technology, the whole thing falls apart. So as a service provider, we need to be thinking forward to not just next week's revenue, but 1 year, 2 years, 3 years, to make sure all of those things are available. And then the market will be a bit more fluid, which is
And
really
next
what we
week's
need.
revenues and next week's customers.
Yep,
Imagine
exactly, yeah.
Which brings us to the closing for you, Sarah.
Yeah, so definitely there is more work and efforts that has been done by Saudi Arabia, and eventually there are more inflows into the market. And I think the exchange is also catching up with the global market capitalization, and eventually I'm optimistic. So I would see there is more grow or exponential grow within the recent or within the next 5 years in respect to the SPL. So as Eli mentioned, liquidity is a key, and I think this has been ticked and been picking up also in the market. So there is an opportunity, there is a growth coming, and there has been so many tremendous changes in the market from the inclusion of MSCI back in June 2018 and look at where we here today. As I mentioned before, the qualified foreign investors holding is 88 billion. So this will give us like a message that the introducing new products to the market, it will attract also more investors, and we will see more demand in the market.
I would like to ask the audience as well, what about the coexistence between conventional and Islamic finance? Where are we today?
So in fact, there is a big percentage, if not the biggest, of assets are held by Islamic financial institutions, right? And if we look to the fixed income repo, the Islamic offering have massively picked up in the recent 3 years. I don't see that SBL will be an exception. The challenge of the Islamic framework on the SBL side is that SBL is an OTC transaction. So any agreement needs to be done between two counterparties. Any Sharia discussion needs to be validated by two counterparties separately. The key element in the Islamic framework is standardization. In the same way that we have witnessed on the Islamic OTC derivatives, on the derivative world, where there is a centralized rule book or centralized Islamic guidance that guide the operation model of any OTC transaction, where the documentation is Islamic ISDA, the TMA, obeying to the TMA, the Tahawut Master Agreement, which is well known and acknowledged across the region. So we definitely need something similar on the Islamic SBL world, and this is even a request from international organization like the ISLA, who's pushing the region here to have a common Islamic regulation, which is known and acknowledged by the local participants.
So I think if you look at it from what we see right now in supply and demand, it's maybe not important from a borrower side, where lots of the borrowers are international, but from the supply side, it's critical that this gets developed, because majority of clients that we deal with are looking at transacting in a Sharia compliant manner. And we've gotten clear feedback that there's ways to do that. But I think, again, it's just getting the standard documentation, the standard terms, standard way that those trades are processed to make sure that they are complying with those rules and with that guidance.
From an international bank perspective,
it's a consideration we have to take on board when we're reviewing the opportunity of the region as a whole. I think, this is a big element of transacting within the region. I do think the work of ISLA are doing is fantastic, and that the trade bodies like that can really help the market to get a consensus view into certain items and in the region, because I think we rely on them to represent us, and they're doing a great job at that. So hopefully we do got some sort of standardization around that point.
I guess from my perspective, like over the last couple of years, we've worked with a client in Saudi to extend the capability of the platform to allow them to trade on a Sunday, which was new for us, something we'd not done before. Likewise, in Malaysia, the Bursa Malaysia have put in place a strong template around how Islamic securities finance will work for them, which made us then provide system capabilities to match that. So any other regulation that comes in any place, you follow that same suit. And it was pretty straightforward. Client-facing trade confirmations to to report slightly differently. So the actual system changes are quite minimal to support it. It's just we wait to get guidance either from our clients or from the regulator on the standardisation, and we were able to put it in quite quickly, and I can see the same thing happening in this region also.
I agree. In fact, when you discuss with stakeholders in Saudi, whether in Saudi or Qatar, they are comfortable that the framework can be Islamic friendly. But again, they need to go to the Sharia board. You have each counterparty has its own Sharia board, etc. Standardization is key, and I agree with you. In fact, the change, even technology-wise, is minimal, right?
It's minimal, yeah. It's just about someone agreeing what the standards are, then they can be rolled out across the market. Yeah.
I mean, creating two systems is one thing. Creating one system, which has the benefits of both, which everybody agrees would be great. We really
Again,
want to
I
talk
think
about that?
it goes back to the question of, is there one way of doing securities lending that works for every single client and every counterparty? And I think the answer is no. So you're going to have these different pockets of liquidity and different pockets of supply, and I think that's going to exist. I think the challenge now is that it's such a new market, we still can't identify what those will look like and what they will be. But I definitely, just like we're saying clients in Saudi or other markets in the region are interested in lending securities, I'm sure there's maybe not as many, but there's a good deal of clients that are also interested in borrowing securities and taking certain positions that they weren't able to take previously. So these are all parts of the market developing, and you'll have those different pockets of maybe Sharia compliant only, and ones that face international borrowers. There's also a lot of other points that will come up, like withholding tax, like dividend treatment, like voting. That all are gonna create different models and different approaches. But as long as you have some agreement and standardization, that's what will help mitigate those risks disrupting the market.
And that's absolutely no different from any region client requirements. Andrew's a French bank by status. You've got a large amount of French clients who have their own specific demands and needs. It's exactly the same, whether it's a UK-based organisation, whether it's Scandic organisations. They've all got their own rules and regulations, and the Islamic Securities Finance is just another client set that we all have to deal with and get it to work in that end-to-end flow.
It comes back to that responsible growth point that someone made earlier, that we want this to grow, we want it to be a success, but it has to be done in a responsible way that takes into account the views of the regulators and the trade bodies, and we work as a collaborative to grow this economy and help and build the market rather than try and go alone and cause issues. So it's all about responsible growth.
So, if I summarize in saying there is a will, so there will be a way, I'm probably spot on. Good, fantastic.